So this is part number 40 of this multi-part video series for positional stock traders. I know we have come a long way. I never anticipated this would have 40 videos. And my mind is planning to make another 10 videos so that we will complete it with 50. One of my students mentioned, why not make it 50? I could end it today also, but let's make 10 more videos. Let's look at 10 more chart examples. So this is part number 40. This is a very important video because in this video, I am going to teach you that just because a stock enters the blue shaded area does not mean that you have to buy immediately. You have to look at price along with volume. You can't buy just on the basis of price. Okay. That is the first thing I want to teach you. Second thing, I also again want to re-emphasize that there is no need for automation. Automation comes with its own weaknesses, and that will be evident if you properly pay attention to what I'm discussing in this video. Okay, so let us begin. As per our SEBI regulations, this is an old chart. This is 10th April 2023. So we are allowed to discuss this. When this base was formed on Sangvi movers, this was base number 2. This was marked as a double bottom, and the relative strength of the stock in this base was 89. Okay, and this is April 10th of 10th of April 2023. If you go back and look at the fundamentals of Sangvi movers in the month of December 2022, the stock was showing triple digit growth in the quarterly EPS and triple digit growth in quarterly sales. Okay. March, their EPS and sales declined, but I think by 10th of April, the March earnings had not yet come out. Okay. Just because the earnings had declined doesn't mean that you reject the stock. There are 12 fundamental criteria. You have to look at those 12 fundamental criteria. If the stock meets 7 out of those 12, then your stock is eligible for a positional trade. So you can go back and look at the fundamentals of this company on MarketSmith, consolidated numbers, quarterly and sales and quarterly EPS. But that's not the only thing we look at. Remember, we also look at EPS stability. We also look at annual growth in EPS. We also look at annual EPS, which, by the way, for this stock was rising for 3 consecutive years. We also look at margins. There are a couple of points given to margins out of 12. Okay. Those are the things that I'm not discussing in these videos because those are the things that you'll have to check live on your MarketSmith platform as you are buying a stock. We don't have much history as far as comparatives is concerned. We don't have history on MarketSmith. All I can check is the relative strength. I can't check uh, the industry group rank. What was the industry group rank at that point in time? We can do a rough estimation, but that would be a very crude estimate of industry group rank. So there are no exact numbers available to study the past. But of course, we can study the chart. Chart is very important. Chart tells us everything. Okay. So given that you have this chart, let's assume that the stock meets your criteria. It's a positional trade. Let's start with that assumption because that makes things very easy. Okay. Just keep in mind that for every stock, you have to do liquidity, comparative, technical, fundamental, and market analysis. Assuming you have done that for this stock and MarketSmith has marked this as a double bottom as base number 2, which is an early stage base, how would you proceed? Okay. So this is a double bottom. Now I have been telling you, don't get into the specifics of how a pattern is formed. So this looks like this: 1, 2, 3, 4, and 5. That is how they mark the double bottom, and the high of this candle becomes the pivot point. Okay. That is the system that MarketSmith is using. Okay. So let's draw the pivot range here. This is more of a trade execution and a trade management video because we want to see what is the right time to buy. We already know the right price to buy. The question is what is the right time to buy the stock. Okay. So now the pivot range, selling range, and the stop loss range becomes extremely important. And I will also refer back to that page number 261 again. Remember William O'Neill's book, fourth edition, chapter number 11, page number 261. He says that true winners don't close below the pivot. Okay. So the high of this candle is 190.65. So 190.65 is our pivot point. Let's do that. 190.65. And then let me take out my old school calculator. I recommend that all of you buy this old school calculator. Okay, be old school like me. Okay, you don't need to be a programmer. So 190.65 into 1.05, which is 200 rupees. So 200. So that's it. That's the buying range. Then we draw the selling range. So this will be 190.65 multiplied by 1.2. That's 228. Then this will be 190.65 multiplied by 1.25, which is 238. Okay, let's give it green color as usual. And stop loss range. Trade execution videos are very interesting because we get to see practically what is happening. So 190.65 multiplied by 0.92, which is 175. And 190.65 multiplied by 0.95, which is 181. Done. So price is between the blue line, which is 10-week simple moving average, and the pivot point. You have a double bottom, base number 2, relative strength 89. Okay. Fundamentals okay in our favor. Now count the number of red bars inside the base. 1, 2, 3, 4, 5. How many are high volume? Not a single one. Even this is not high volume. Okay. Not a single red bar is high volume in this base, which is fantastic. Okay. Which is what we want. So now let's execute the trade. So Monday. Now, before you execute, listen to this carefully. Okay. Listen to this very, very carefully. This is what I want to teach you in this video. What's the average volume, weekly volume now? Okay. It is 1.39. Okay. So 1.39 is the average weekly volume, which means Monday, how much volume should you expect? 1.39 million divided by 5, correct? 1.39 million divided by 5, because there are 5 days in the week. So 1.39 million divided by 5, which is 0.278 million, which is multiplied by 1 million. Okay. 278,000 shares should be traded on Monday. Okay. Only then we can say that, okay, this could be a high volume week. Let's see what we get on Monday. I will click here. See, what do we get? 130.78, which means we were expecting how much? 278. How much did we get? 130. So 278 divided by 130K. Like we are getting half of what we are expecting. So if we are getting half of what we are expecting, will you buy? Will you buy the stock on Monday? See, Monday the price went inside the blue shaded area. It broke the pivot. But there is a very high probability that at the time it broke the pivot, it was not showing much volume, right? Plus, if you had waited for the end of the day, see, if there is no volume coming in, price action on the upside is very less likely. Maybe the stock touched the pivot and then fell back quickly. Okay. If that happens, does it not make sense to wait till the end of the day, or does it not make sense to keep an eye on the stock? Okay. For price and volume. In this case, look at this bar. This is not a weekly bar. This only contains Monday. We are getting half of the volume that we are expecting. So there is a very good chance that if you understood price and volume properly, you would have probably not bought the stock. Okay, what's the high of this? It is 19, sorry, it is 191.60. What's the pivot point? 190.65. So it's just 1 rupee, right? It's just 1 rupee. The stock might have gone up, touched that one, spent some time, maybe 5 minutes in that 1 rupee area, and then fallen back. Okay. So please give the stock some time. And there is a good chance that if you track to the 5 minute, 15-minute chart, you would have seen very low volume coming in because this is half of what we are expecting. Well, I don't encourage you to go to the lower time frame chart, but I'm just telling you that as far as volume analysis is concerned, this is poor volume on the on Monday, half of what we were expecting. So there is a good chance that a professional trader would not have bought the stock, maybe waited for Tuesday. Okay, let's go to Tuesday. Now, Tuesday, how much are we expecting? 0.27 multiplied by 2, right? So let's see, 0.27 multiplied by 2. So 0.54. Okay. How much are we? So 540,000 basically. How much are we getting? 266K. So which is again less than half of what we expect by the end of Tuesday. Okay. Moreover, the price didn't even go inside the blue zone. I think it went momentarily in the blue zone. Let's check again. So this is Monday. Price went inside the blue zone, poor volume. Then this is Tuesday. Yeah, price slightly went inside the blue zone, maybe 2 rupees above the pivot point. But was the volume coming? No, the volume was not coming. Okay. Now the price has again fallen back below the pivot. Remember that page number 261 statement that applies to a weekly close. At least we are applying it for a weekly close. That is not what he specifically mentions in the book. So even Tuesday, you would not have bought the stock because the volume is still uh, less than half of what we are expecting. So let's see what happens on Wednesday. Wednesday, again, nothing happened. And I don't think the price went inside that blue zone. Okay. And actually, the price came down. It has become a red bar now. So Wednesday, nothing has happened. If you want to see again, I will repeat it for you. Monday, the price went inside the blue zone, no volume coming in. Tuesday, the price slightly went up. This is 192.85, but came back down again. So Monday, Tuesday, you don't get a chance to buy. Wednesday, again, it never went and touched the pivot. It just came down. Okay. Probably it might have touched the pivot, but not touched the high of the Tuesday, which is 192.85. It's just 2 rupees different. 2 rupees on a weekly chart is nothing. 1 or 2 rupees on a weekly chart is really nothing here. Okay. So again, by Wednesday, how much volume do we expect? 0.27 multiplied by 3, 810,000. How much do we get? 329. Again, less than half. Let's see Thursday. Again, Thursday, it turned green, but it hovered in the same area. Again, by Thursday, how much volume do we expect? 0.27 multiplied by 4, which is 1 million roughly. Here you are getting like how much? Here you are getting like 398. So less than half, it's almost 1/3 of what we are expecting. So Friday also, again, nothing happened, less than half. So as you can see here, the actual is almost half of the blue color, correct? Which is what we expected. So this is not the weekly breakout bar. Now remember William O'Neill's statement, true winners don't close below the pivot. Now this has closed below the pivot. Okay. But have we bought the stock? We have not bought the stock. Has the pattern changed? No, the pattern has still not changed. It is still a double bottom, right? Is the price still between the pivot point and the blue line, the 10-week simple moving average? Yes. Since it is extremely close to the pivot but below the pivot, remember it will show in red color on the top right corner of market smith chart, maybe it's down 2% from the pivot point. So market smith will say that this stock is down 2% from the correct pivot buy point, and it will show it in red color. Now remember the automation that my programmer friend had told me. If you put that automation, it will remove all the stocks which have either gone away from the pivot or touched the pivot and came down. Okay, so this stock would have been rejected in that particular filter. But looking at this pattern visually, do you think you should reject this stock? No, it's a double bottom. It's a double bottom. Okay, it is base number two. Out of five red bars inside the base, all of them are low volume. Okay, this is base number two, relative strength 89. Just because it attempted and failed doesn't mean that you reject the stock. There are tight closings inside the base. Look at this tight closing inside the base. Just because it touched the pivot and came down slightly doesn't mean that you reject the stock. Now, see, if it had to come down 5%, 10% down, or maybe if it had to breach the 10-week simple moving average on the downside, well, that it makes sense to reject the stock. But this is almost at the pivot. What's the price? 188.80 is the closing. 190 is the pivot point. So it's just 2 rupees to the pivot point. So it's not a big deal, right? We can give this stock another chance. The stock could make an attempt again in this particular base. You understand? So let's see what happens on Monday. Fantastic. Now, before Monday, let's go back to our volume analysis. Okay. What's the volume on this? What's the average volume on this bar? 1.17 million, correct? So what do we expect the next day? 1.17 divided by 5. 234. That means 234,000 volume is what we expect on Monday. If the price enters the blue shaded area, if the volume is more than 234,000, it makes sense to buy the stock. Okay, let's see what we get. Monday, how much are we getting? 348. So 348 divided by 234. So we are getting 1.5 times, which means 50% more than what we are expecting. Moreover, the price has not only entered the blue shaded area, but it almost attempted to cross the blue shaded area on that same day. What does that mean? That means you would, on that same day, first when it enters the blue shaded area, you will attempt to buy maybe 10, 20, 25 stocks because this week's hangover is still there in your mind. But as you see volume coming in, you buy 50 shares, then you buy 30 shares, and probably you buy 20 shares all on the same day because we are getting 50% more volume than what we expect on a Monday. And remember William O'Neill's statement in the book, what he has written, a true weekly breakout is when the stock breaks out on a particular week with 50 to 100% more volume than the average weekly volume. Now, in this case, we don't have the weekly volume because it's only Monday. You still have Tuesday, Wednesday, Thursday, Friday to come, which means what? Which means you have to rely on the volume of Monday. So, which means what? Which means you need the expected volume on Monday. Where will you get it from? From the previous week average weekly volume, right? You take the previous week average weekly volume, divide it by 5. That is what we expect on a Monday. On this chart, we expect 234,000 shares to be traded on a Monday. We are getting 348,000 shares traded on a Monday. And that too on a day when the price enters the blue zone and tries to break out of the blue zone. What does that mean? You buy 50 shares, you buy 30 shares, you buy another 20 shares. Okay, if you plan to buy 100. So you whatever shares you plan to buy 50%, then 30%, then 20%. Buy it in 3 tranches on the same day because you are getting the volume that you are expecting. And there is a danger, there is a risk that the price might go out of that blue shaded area, after which you might never get the opportunity to buy the stock. So in this week, you are being extremely cautious because of that poor weekly volume. In this week, you are equally aggressive, right? On that too on a Monday because you see both price and volume action. So everything in trade execution depends on price and volume. You want to go and check the intraday charts, go and do that. But I prefer to stick to the weekly time frame chart because that gives me a sense of what is happening. So let's say I'm expecting 234,000 during the day. And let's say by 12 o'clock, the volume has already crossed maybe 200,000. Okay, what does that mean? It's half a day. You are expecting like 100,000 approximate volume based on what we are expecting. And it's already crossed twice of that. So by 12 o'clock, the volume has already crossed twice of what you expect by 12 o'clock. So if it's 234,000 during the day, then by 12 o'clock, it should be 100,000, something like that. Now, instead of 100,000 at 12 o'clock, if you see 200,000, I mean, what is the need to go to 5-minute chart, 15-minute and a daily time frame chart? The volume is clearly telling you yet that you are getting twice of what you expect. That too at 12 o'clock in the noon. Okay, buy the shares, as simple as that. And moreover, at 12 o'clock, if the price is attempting to close out of the blue zone, you might not want to miss that stock. So you will pick it up. Okay, move it to Wednesday, sorry, Tuesday. Again, Tuesday you would end up buying more. In case if you miss out on buying all your 100 shares, you would end up buying the remaining shares. Let's say on Monday you bought 50 shares, 50%, 30%. You still don't have the 20%. You buy that 20% on a Tuesday. It's still high volume, close inside the blue shaded area. Very, very simple. Okay. So this is the real breakout. So by Tuesday itself, the stock has touched the blue line on the weekly average volume chart, right? So by Wednesday, Thursday, Friday, okay, it's already a high volume week, and the stock is still inside the blue shaded area. Nothing to worry about. Okay, it is still closing above the pivot. Remember, true winners close above the pivot point. Okay, please understand that in this week the stock closed below the pivot does not mean we reject the stock. At least keep it on your watch list because the pattern has not changed. Okay, if you use very, very strict filters, if you start using pattern recognition filters, this stock will not even show up in your filter. So be subjective, be simple, be flexible, keep an eye on price, volume, moving average, the red bars, the volume relative to the red bars, the price relative to the moving average, and the pivot point. Price action around the pivot point. Most importantly, volume. Okay. And then we will move it forward. Look what happened. In this week, the stock went below the pivot. Did it close below the pivot? Remember page number 261, chapter 11, William O'Neill's book. True winners don't close below the pivot. Did it close below the pivot? No. Okay. Is this a weak closing or a strong closing? It's a strong closing. Okay. Because the closing is above the midpoint of the bar. Is it coming on high volume? Absolutely yes. So this is actually a bullish bar. You might think this is a bearish bar because of the red color, but look at the closing. The closing is above the midpoint of the bar. It's a strong closing on high volume. It's a strong closing. It's a down closing. It's high volume closing, which means it has bounced from the bottom. The stock has refused to close below the pivot point. The stock has refused to close below the moving average, the 10-week simple moving average, both in our favor. Okay, look what happens. That bounce created in 15% rise in the value of the stock in a single week. You are in the green zone. You could choose to do partial selling. Now tell me one thing, if this is base number 2, obviously you will do partial selling because you bought the stock early and you would like to ride the stock. What if this was base 3 or base 4? You would sell more than half of your shares here. Okay, remember, if you are buying late, the more late you buy, the more the number of shares you should sell here. Okay, by the way, always keep some shares with you. Don't sell everything because you never know how long the stock might go up, right? So keep that thing in mind. Uh, if you are buying a late stage base, if you're buying a late base, you will have to sell more than half here. If you are buying an early base, it makes sense to sell only 1/3 or one half of your shares, or maybe less than one half of your shares here because you want to ride out the entire trend. Keep the remaining shares as long as the price remains above the 10-week simple moving average while keeping your stop loss to the break even. And this bar has already tested the stop loss. It has tested the pivot point. It has also tested the 10-week simple moving average. Okay. Very, very simple trade, easy to understand, nothing complicated about it. That is why I keep saying don't get into too much automation. Focus on the stock, visually analyze the base, it will help you. Another learning from this video is just because the stock breaks the pivot and comes down doesn't mean that you outright reject the stock. If it is very, very close to the pivot, it is very near to the pivot, okay, then keep the stock on your watch list. If it falls down like 5%, 10%, that's like we don't want to buy a falling stock. Okay. Thank you so much.